We're going to switch gears right now for a moment and talk about the streaming wars. Apple TV Plus launching just last week. Disney Plus, of course, launching next week. Yesterday, I had the chance to sit down with Netflix's CEO, Reed Hastings, at the DealBook conference. Here's what he had to say about the growing competition in the streaming space.
People will subscribe to a couple services the way that they subscribe to a couple news services. But then on terms of time, that's the real competition. The tricky thing in this streaming war is, Apple and Disney's not going to break out revenue for the service. And you'll hear some subscriber numbers, but you can just bundle things in, so that's not going to be that relevant. So the real measurement will be time. How do consumers vote with their evenings? And do they end up watching what mix of all the services? So starting in Q1, you'll start to see a breakout of that, like from Nielsen and others.
Joining us right now to talk streaming competition, Larry Jones. He's the CEO of Blackthorn and a former president of TV Land. And Mark Mahaney is also joining us this morning, lead internet analyst at RBC Capital Markets. Curious about your take on Reed's take on how to really measure the success of these services. Is it really going to be time? Is that the best way to estimate how we're going to look at these things, Mark?
I guess so, but we're not going to get that kind of disclosure from the companies. So right. I'm sorry, the street's going to look at subs as it has for Netflix historically, and it's going to listen for the sub numbers from the other companies. All three of these companies that have been, the estimates are out there. They're going to get roughly to around 100 million within 5 years. That's Apple Plus, Disney Plus, Time Warner Max, and HBO Max. And that's going to require good execution in the U.S., but particularly really good execution in international markets. What we're learning from Netflix is that 90% of the sub growth now comes from outside the U.S., so you got to have content for those markets. That's going to be a tough road to hoe for some of these companies.
Well, that's what I was going to ask you, Larry. In terms of thinking about Netflix and their growth prospects in this competitive landscape, is the focus, should the focus only be international, or do you think that they're going to have to hold what they've got in the U.S., but then it's got to all be an international game?
I think that you have to make hits. And I think that's what their number one agenda is. You make hits in the United States, and then you export them around the world. I mean, that is basically what their plan has been. Build up that library and have a lot of great content that people want to watch all around the world. Right. But clearly, they'll be making projects for specific markets around the world, but I think it's going to be predominantly an exported American.
But when you say hits, and this is a very interesting issue, because it seems like Bob Iger and some of the other services, especially Apple, which obviously has a lot fewer shows, is playing a very curated, hit-driven strategy to the extent that they can be right, and we'll see whether they have those hits, versus Netflix, which is trying to do hits, but is also a little bit of a volume game.
I would definitely agree that Netflix is a huge volume game, but they're the first movers. They've been in there for 8 or 10 years now already. Everybody else is trying to do catch up, either with their pre-existing IP or creating new IP. But Netflix is in a position where they can have a lot of volume, but everybody in town wants their Game of Thrones. Everybody wants their Handmaid's Tale. That's the thing that creates the buzz. That's the thing that people are going to be talking about. That's going to drive the subscription base. And I do agree completely that it is all about subscription growth.
Hey, Mark, one of the things I asked Reed was, are we in a bubble? And at some point, does the content spend have to come down or at least slow in a material way? And he seemed to suggest not. Does that make sense to you?
Yes, it does. I think that Netflix's strategy is going to be to continue to spend more. They're going to bump up their content spend each year by, $1 to $2 billion a year. They do that because they think they can add 25 million to 30 million new subs a year. That translates into about $3 billion in incremental revenue. So they're going to put half of that into new content. And Netflix's strategy, whether it works or not, is going to be to bury people in content. And by the way, the real key thing here, since the growth, the race is really in international markets, Netflix in 2020 is going to roll out 130 original series that are internationally sourced, internationally produced. They're going to be, there's going to be Japanese, South Korean, Turkish, French shows. That's it's not going to be taking U.S. content and exporting. It's actually going to be creating it in international markets. That's where the play is.
We go back to the question: does the valuation, though, of the traditional guys, does it go up, and does it go up and try to match, and Netflix come down? I mean, how does that work?
That's one of the toughest things to figure out here. It's going to depend on whether the free cash flow dynamics start to improve. So Netflix has shown that you can spend a lot of money and build out a huge sub base. What Netflix has yet to prove is that you can do it with profitably, at least in terms of free cash flow. So if Netflix can't do it with what's going to be about 200 million subs, it's going to be pretty clear that almost nobody can do it. So Netflix is going to be the free cash flow bellwether for this sector. I think they can do it, and if that's the case, then you're going to see other companies that can reach that 100 million in scale. The market's going to respond favorably to them. I think the issue is going to be within 3 to 5 years, we're going to find out there's maybe 2 companies, maybe, that can get to that kind of level. Netflix and Disney. That's probably it.
From an investor standpoint, though, I think the larger question mark is what is the right multiple to put on Netflix now with the increased competition that's out there? Also, you're basically telling me that Netflix is going to keep spending. Presumably, it's going to have limited ability to raise price because of all the competition out there. So to make up for that spend, it's got to bank on that volume out there. And so it's a different business than what Netflix had a couple of years ago, even.
Yeah, Netflix has changed. I mean, there's no question that the biggest overhang on there's 2 overhangs on Netflix's stock. All this competition and whether it does what it does to sub and pricing power, and then whether they can turn the needle on the free cash flow. This is supposed to be the year of peak free cash flow losses. If it isn't, this stock is capped and it's going to probably correct 20, 25%. We think there's enough leverage in the model that they can show that improvement in free cash flow next year. But, if they can't, then, this stock cannot work. We think they can show it. We have seen leverage, by the way. You can look at content costs in the U.S. They've shown about 10 points of leverage over the last 5 years. So there is leverage in this business.